I should start off this podcast by coughing because that's a lot of what I've been doing. It has been absolutely crazy, 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 crazy. How much sickness and virus and flus and headaches and upper GI issues the Peck household has had over the last probably 5 weeks. It's absurd. I've had two colds. Since December 23rd, I've had two colds. My son threw up on my laptop, which completely destroyed it. No, the cloud did not save everything. No life or death or anything here, but um, the cloud still has to work its stuff out. So there are some missing things. So the computer got sick. Then I got over the two colds, and then I got a flu, which then turned into the norovirus. So it has just been 6 weeks of, I guess, humility and just gratitude for the days I feel better. And there, in that 6 weeks, there was probably 2 weeks where I was back to normal. But anyway, health has a way of reframing everything much, much more than the markets. And we're absolutely going to talk about the markets. So I've been hearing a lot of talk lately about inflation. And inflation was a huge topic back in 2008 and stayed a huge topic since then because of all the money printing from the Federal Reserve and the European Central Bank, China's credit, and Japan's printing. And yet we never saw inflation. Never saw inflation with trillions, tens of trillions of dollars. I mean, tens and tens and tens of trillions of dollars printed and still no inflation. So there's been a lot of talk about inflation, and that then gets the newsletter industry going, talking about hyperinflation and lives not working out and futures not working out. So what I want to do is look to the price charts and let's just see what's actually going on and step away from the headlines and the marketing, and let's just look at something that filters the noise and just gives us the most important information. Hey everybody, this is RC Peck, and this is my weekend podcast, The Science of What Really Works in Investing and Growing Wealth. It's so good to have you here. I'm probably about 70% today, which was much better than Monday, which I would have put at 10%. It felt like literally a truck hit me and I could not move. The last time I felt that bad was when I was living in India and I was stuck in a town called Vellore, which has a medical college there, a well-known medical college in India, CMC Vellore. And this was back in 1995. If you don't know where Vellore is, and most people don't, it's outside of Chennai, which is the southeast part of India. So let's look at some price charts here, specifically interest rates. So look at this right here. This is a 20-year price chart of a U.S. 30-year Treasury bond. This is the price. Okay, now when price goes higher, yield goes lower. So there is no inflation going on right now on the long end of the yield curve, meaning those really long-dated bonds. In this case, a 30. So no inflation, long-dated U.S. bonds. Now we go to the 10-year, and I don't see an inflation either. This is a price chart, meaning it's measuring the price of the 10-year Treasury, not the yield. So I have that nice red rectangle showing you that the 10-year price, the 10-year bond price has been going sideways for 5.5 years, and it's in an uptrend. The two black uptrending lines. So until this price breaks out of that 5.5 year channel and breaks down out of that beautiful uptrend, there is no inflation in the 10-year. All right. Now we go to the 5-year. Now 5-year looks a little different. And I apologize. This is yield, not price. So now I'm looking at yield. So when you see this line go higher, that means yield or inflation is going higher. So in the 5-year Treasury, we can see that the 5-year Treasury bottomed from a yield point of view, which means it peaked in June of 2012. So now that's interesting, right? We know that the 5-year Treasury peaked 5 years ago. Well, almost 5. This June will be 5 years. And the yield's been, generally speaking, going higher. Clearly not every day, week, month, or year, but the yield spiked here in 2013, really digested that huge move, had a correction, and has moved higher. But really what I see is this trend now moving higher for the 5-year yield. So, the yields are increasing on the 5-year. Okay, we're just still kind of looking at the data here. And then here's a 2-year, looking at yield. Clearly, same thing is happening with the 2-year Treasury. These are all U.S. Treasuries, by the way. And you can see here, very similar to the 5-year. It's been trending higher. Now, this, interestingly, bottomed in 2011, where if you remember, the 5-year Treasury bottomed right here in 2012. So we got the 2-year Treasury saying, yep, we're kind of, I think of this as reflation. It's not really, to me, inflation. It's kind of reflating from the zero interest rate policy that our government, the U.S. government, has been under. I think the Fed's part of the government. And same thing, I'll go back to the 5-year. This is reflation to me. So we've got the 5, this is the 2-year going higher. Now this right here is the federal funds rate, which here's the global financial crisis here. Bernanke dropped rates to 0. This is a logarithmic chart. That's why it looks like these moves are much bigger than these. But down here is 0%. That's 0.2, 0.4. And then here, just for reference, is 2.0, meaning 2%. So that's why it looks kind of maybe wonky to some people. But clearly in 2014, federal funds rate, and the Fed allows the number to bounce between 0 and 25 basis points, and that's what it was doing. But very, very short-term rates bottomed in 2014 and have been moving higher. And then we have the prime rate. Now, if you don't know the prime rate, most second mortgages, or what are called home equity line of credits, HELOCs, are usually based off prime. And you can see prime started moving up at the end of 2015. So what we have is the 30-year, nothing's reflating, no inflation. The 10-year, sideways, 5.5-year channel, not much. The 5-year Treasury, yeah, yields are reflating. The 2-year Treasury, yep, yields are going higher. Federal funds rate started, well, in hindsight, we know it bottomed in 2014. So that's been moving up for 2 years. And prime rate has been moving up. So as far as interest rates go, and when we talk about inflation, you got to remember there's no one number for inflation, right? I mean, inflation of what? Assets? The stock market's been in hyperinflation the last 8 years. I'll look at real estate in a second. Are we looking at things you have to have, not things you want? Things you have to have, like food and energy? Because that's different. If we look at food and energy, this is a price chart of all the commodities in one price chart. Think of it as like the S&P 500 of commodities. And if you look at this, I don't see any inflation. Now, yes, I see that it bottomed right here a year ago and it's moved higher, but it's still below this bottom point of 2009, that kind of the 200 mark. So to me, this is just kind of looking like reflation. So as far as commodities go, I have not seen, and actually let me rephrase that, it's not about me. Inflation is not showing up in staples, meaning wheat, coffee, sugar, cocoa, oil, natural gas, things like that. Yes, oil bottomed at $26.50 and it's about $50. That's West Texas. But again, guys, it dropped from $110 down to $26 and it's finding some equilibrium at $50. I would hardly call that inflation. So we're not seeing any inflation in commodities. But we are seeing interest rates, the short end, The 30-day, the 90-day, the 2-year, the 5-year, the federal funds rate, prime rate, those are moving higher. And I guess I think of them more as they're reflating because they got artificially crushed down to where they probably should never have been because of this government's zero interest rate policy. So I'd probably call that reflation. But please, the scare tactics are going to start coming out about hyperinflation and whatever your future getting crushed and whatnot. Not happening, guys. Price charts are not telling us that's happening. And then I just want to show you a price chart of housing in the U.S. This is the Case-Shiller National Home Price Index. I show this every once in a while. It bottomed in 2012. It's going higher. Now, why do I bring this up? This is an asset. I didn't put the price chart of the stock market in here, but I did mention it's been in kind of inflation mode since the March of 2009. And here's housing. Now, the reason I want to put housing in here is because this asset is showing, I'll call it some sort of inflation. But again, what you have to understand is this price right here has a 10-year treasury of, I'm going from memory here, 2%, 2.5% right here. And if we go back here, the 10-year treasury in 2007 was probably 4.5%. And back in 2005, it was probably 5.5%. So we're looking at housing prices go up, but borrowing money to buy, the other 80% or borrow the 80% from the bank is still way cheaper than it was back in 2008 or 2006 or 2005. So housing is still going higher. And I wanted to bring up housing because Harry Dent is out with another round of fear-mongering. A client forwarded me an email from the Harry Dent organization saying that this year, real estate, 2017, real estate's going to crash. I think the word he used was collapse, 30 to 50%. Really? Really? Harry? Really? Come on. I mean, at some point, can't you just stop the insanity? Guys, if there's an imminent real estate crash coming, the price charts do not see it. The stock market does not see it. The bond market does not see it. In fact, no one sees it except apparently Harry Dent. Please stick to the price charts. Okay, so what's the takeaway? So do we have inflation? Not quite yet is what my answer is going to be. Short-term interest rates, they are reflating. I don't even know if that's an economic term or not. I didn't study economics. I studied price charts and human behavior. But short-term interest rates are reflating. And by the way, guys, that is a really good thing. I would like to see the federal funds rate, right now it's at 0.75, maybe at 1.5%, maybe 2%. And the reason I'd like it there is because I don't think borrowing money should be free. Because then what happens is, you borrow money, probably shouldn't be borrowing money, and you buy back a bunch of your stock because you're not going to build more capital equipment because that's too expensive, but you can borrow money at super low rates, buy your stock back and kind of artificially inflate it. So it's given us this kind of artificialness. And yet the stock market knows what's going on and it adjusts to that. So short-term interest rates, guys, let's just call them reflating. Long-term interest rates, long-term, they are still in an uptrend. The 30-year price is still trending higher. After 35 years, the 10-year treasury is in a 5.5-year sideways channel, but that channel is within a 35-year channel going up and to the right. And then, guys, stuff. I'm not seeing inflation show up in stuff. Right? I showed you commodities. Now, yes, it's showing up in assets like real estate and the stock market. but it's not showing up in stuff. So until it does, I don't really think there's anything to worry about. The one thing I will say, and we're not there yet, the one thing I'll say is people who have a significant amount of money in bonds, which probably means anyone over 60, there will be a day when bonds bottom. And it could very well be that bonds have already bottomed. They just haven't broken down yet. And I showed you that with the 10-year Treasury house in that 5.5-year channel. So it's very well that we have seen the low lows in yield, and now we're in a bottoming process, which is totally fine, meaning I have no bias. There will be a point where that bottoming process ends. It's a bottoming process from a yield point of view. It's a topping process from a price point of view. There will be a point when that ends, and then the reverse happens, meaning yields will enter into a long-term uptrend. Not in a hyper way, but I think a nice, slow, general uptrend. And when that does happen, that's going to put a lot of downward pressure on bonds. And one of the reasons why bonds have been great over the last 17 years, well, they've actually been great over the last 35 years, but over the last 17 years, they haven't had as much competition from the stock market. That will change in the next few years. And so my concern with a lot of this big box conventional thinking is they just do what the person told them to do before, and they don't actually check and see what really works. And so people who have large exposure to bonds, there will be a point where they start to get hurt. They will never necessarily see it. Their money will just buy them less and less and less and less over time. That's why I don't believe in these conventional ideas like the 60-40 split, or if you're over the age of 60, you should have 60% of your money in bonds. So anyway, guys, I'm my throat is starting to hurt. Guys, this is just another step in helping you protect your portfolio and protect your future. Until next time, this is RC Peck. Hey guys, thanks so much for being here. Thanks for letting me cough kind of in your ear a little bit. I am slowly getting better. So that is very good news. I finally finished my most recent research on the 5 shifts that my top clients have all done who have grown their money the best over the last 2 decades. I'm super, super excited about this. One of the things this outside consulting company did was they audited my clients and they looked at them and said, okay, let me look at these hundreds and hundreds of people, or thousands and thousands of people. And of the ones that took your advice, which ones implemented it, which ones didn't, and of the shifts. And we identified these 5 shifts that all that are needed. And so then we went out and said, okay, clients, which of these 5 shifts did you not use, or did you stop using? So I presuppose they stopped using some of the 5 shifts. And the clients who said, no, I'm still using them. And then when we asked them their returns over the last 20 years, they were head and shoulders above the other ones. Meaning clients who said, well, I used 3 of the 5 shifts, or I used 4 of the 5 shifts, or I used 2 of the 5 shifts. So I put together a training to show you what the 5 shifts are, because this is extremely powerful. Now, what's so amazing about these 5 shifts are 4 of them are 100% in your control. And of the one that is not 100% in your control, 80% of it is in your control. So this is a really big insight, because most people say that investing in the markets is out of their control, and it's actually not. So please keep a lookout for that training, the 5 shifts. I sometimes call them the 5 power shifts, and I look forward to getting that to you. You guys take care of yourselves. I'll speak to you soon.